You talked already about the general level not being enough. You started to drill down in 3 different ways. You already done the data sets for countries. You've done the data sets for U.S. states, and you're in the process of doing the data set for corporates. Let's take those one by one and talk about places that are prepared and other places that are ill prepared, and then also how you can invest against that.
Yep.
Let's look at country risk first and foremost. What does your data set say on the country risk factor?
Yeah, sure. So, I mean, it's pretty broad, and it covers, I think it's 43 different countries. We have 7 major indicators and then 33 sub-indicators. Mm-hmm. So it is a big amount of data that we have there. And we generally get those information from publicly available sources, whether it's through Bloomberg or OECD or some other places where we collect that data. And then we try to make some educated guesses and educated decisions based on the analysis that we've done, the data that we see, and the outcome that we get. So what we have right now is we have the full data set, and the key indicators for us are, number one, demographics. I mean, that is a crucial aspect where we see different demographics and demographic trends in the various countries that we look at. We look at government health, so how strong or how well equipped a government is, and maybe the interesting features here would be debt to GDP or stuff like that, or if they have a sovereign wealth fund, the Saudi Arabias and the Norways, for example. We look at government stress, and that is how big of a component, for example, is your public sector as a total of your workforce, right? And here we see some Scandinavian countries which have very large public sectors, and then some other countries more in the emerging markets which only have a very small public sector. We look at the health of the individuals, so that's not how healthy they are, but how financially healthy they are,
right.
Which is more, let's say, GDP per capita, or to see their assets and liabilities, so household debt to income or other indicators. Then we look at whether those pension funds are funded or in a pay-as-you-go structure. So here we have some countries like Netherlands, Denmark, and others, Canada also, who have a large portfolio of funded pension funds. And then you can see others, such as in many European nations, which are in a pay-as-you-go structure. So that is very, very different.
And that includes Germany, is that right?
That is correct, yeah.
Right.
Yeah. Another one is that we look at mark-to-market risk, and that is a little bit of a controversial one. At least that's the one pushback that I've always gotten from my colleagues, which is, it is great. So without a doubt, it is great to have a funded pension plan. But if that funded pension plan is, let's say, heavily invested in equities and they experience a significant drawdown, just that headline front page of the newspaper, pension fund of the Netherlands lost 30%, that will have an impact on confidence, that will have an impact on how people feel. In Germany, this would not happen because there is nothing that they can lose, really. So that is, let's say, a small ding on the extremely positive feature of having funded pension plans. And then, of course, we need to look at the difference between what is promised and what is actually what the pension fund or what the countries can deliver. And here it is, we look at what are, let's say, the median salary, what is the pension as a percentage of that median salary. For some countries, it is very close to 100%, that you get almost 100% of your salary. For other countries, it is only 60%. And of course, there will be massive differences in terms of your ability to fund a promise if you didn't promise that much. If you promise the world, of course, it will be pretty hard to satisfy that.
You know, I want to go into the relative health of all these different countries, but as you were talking about the promises, immediately I thought about Greece in particular, and I thought that this would be a good sort of test case to think about how these parameters are put into place, because one of the more important pieces of the IMF austerity package that Greece had to undergo involved the pension problem. talk to me about where Greece, as an example, stands on some of these issues. Where is it that they have difficulties?
Yeah. I mean, I don't know all the data by heart of my models, but it is Greece consistently scores badly in all of those indicators. So of course, it is on the government health side. Of course, they have debt levels which are extremely high.
Right.
We have a dip in the population health or financial health of their population, especially throughout the crisis. Then you have extreme obligations. You have a very bloated public sector.
Right.
And I would say reasonably generous promises, and they have been reduced. So that is one thing where we can see that Greece has improved in their ratings, but it is not to an extent where we say they solved their pension issues. But they have quite a few issues where you say, or where we see Greece actually scoring at the bottom of each of those indicators. And I would say in the overall ranking, and we can also share this with your viewers, Greece is probably in the bottom 3 or 4 nations globally. The other prominent
And that's even after the pension
That's
reform.
right. Yeah. I mean, with all of those models, I think it's also fair to say that they don't explain everything to the last bit of the detail, because there's always a lagging effect, right? The major lagging effect that occurs is that data for a lot of those international organizations only come out once a year. So we do see some minor improvements already, but that is where we take the qualitative part and the quantitative part of the models, where we just say, look, we know that they're working on it. We know that they're making improvements. So that is something that we can already adjust in our minds. The pure data is still a little bit lagging in this, and it will probably catch up based on our qualitative assessment of what's going on in Greece.
And mentally, as you say that, I immediately think back to Greece issuing a negative yielding bond for the first time ever recently. So you have that dichotomy, and that's really where the heart of where you're going. So can you tell me, from on a macro level, who are the best prepared, and who are the least prepared countries? And then, perhaps as a bolt-on later, we can talk about what does that mean in terms of how you invest against that.
Yeah, sure. The best ones are like in Iceland is extremely good. In Netherlands is very good. We have South Korea is very good. But for us, it is like one is the overall ranking, but another one is always to see why do we get to those overall scores. And here we have to see why is Iceland, let's say, top? And that appears, let's say, a little bit of a surprise. It was also a surprise to us, where we say, then we have to drill in and say, what is the reason why Iceland scores so well? And it basically comes down to them having made tough decisions in the 2008 crisis. So they have made quite a few adjustments during that time. And it's also that they don't promise so much. So the promises that they are giving out to their public employees are reasonably moderate based on how, let's say, advanced the nation is. Because usually there's a high correlation to how advanced you are to what you promise to your public employees. And they are undershooting on that score. Plus they are reasonably wealthy, let's say, as individuals, and the government has cleaned up their act quite a bit.
And that's a good juxtaposition to Greece in that case.
Yeah.
Because both of them had crises. Iceland made the adjustments that you're talking about, and they didn't already have the pre-existing high promises that Greece had relative to their, per capita GDP.
Yeah. Yeah. I mean, and those promises, they usually just ramp up, right? During good times, it's easy to just promise a little bit more and to give in to demands in order to avoid whatever it is, a strike or some trouble. I mean, we see now in France also how...
Yes, Macron.
Exactly. I mean, he's doing exactly the right thing, right? He is pushing hard, in my mind, pushing hard for the right things, but the opposition is pushing back and is basically, as it can easily happen with public sector employees, they basically are in control and in charge of a lot of really, really, really important parts of our society. So there is a very, very fine line of how much can you push, how much can you increase, let's say, the retirement age or increase contribution versus still making sure that you get all your essential services, and of course treating your public sector employees well, who are in some cases relative to the private sector not adequately compensated.